welcome. Thanks again to MoneyShow for putting this on. And like, wow, what a great turnout, guys. Here we go. Okay, we're going to have some fun. So how many people is the first time you've listened to Mr. Netto speak? Let's see some hands. I've been friends with, is he already gone? So he's already out of the room. I've been friends with him for about 15 years, and that's Netto just normal pace of speaking. So I'm going to try to keep it going. I have a very slide-intensive presentation. There's a lot of stuff going on in the markets. I'm at 50 slides in 25 minutes, so I think that's 30 seconds a slide. I was on the plane cutting those slides down, so I'm going to hit you hard. If you want, go ahead and download, if you want, on your phone or your laptop, if you go to tradinganalysis.com/slides, they'll ask you to put your email in, and then you could download the presentation. We have a lot of charts. I've got live positions. It's going to be a very kind of detail-oriented presentation. So let's do it. All right. I always remind myself. I always forget to do a selfie. Is anybody wanted here by the authorities? Anybody don't want to be on social media? No? All right, guys. Can we say, what do we say? Hold on. Wait. Ready? Everyone wave and say, hi, MoneyShow. That was weak. I got to fire these guys up. All right, let's go. Here we go. All right, so just a little bit about me. I'm Todd Gordon. I'm founder of tradinganalysis.com. We are a research, trading analysis, alert business. I trade my own capital as formerly a hedge fund guy. You may have seen me on CNBC. We trade primarily stock options. We have a Forex as well as a crypto division. We strive for full transparency. So, like you guys are here looking to hone your craft. We work very hard to try to be very transparent and show you the inevitable ups and downs of trading. I'm from upstate New York. I was in the city. I was in LA. I was in New York. I just moved back upstate to Sarasota Springs, where I'm from. It's great to be home. Got a beautiful family, and life is good. All right, so there's the team at Trading Analysis, one of which is my mom. The rest are not my mom. Good team at TA. If you, any I won't put you on the spot. It's a secret society. All right, so we're going to talk about some live positions, guys. There's risk in trading. We are very, very adamant about accepting risk up front. We're not a get-rich-quick company like Netto. Very much kind of putting it all there on the open. We have losing trades. We have winning trades. I show real capital. It's a boxing match. That's all trading and investing really will ever be. So only risk capital that you can afford to lose. Know your risk before you go into a trade. Okay? All right, let's go. So, guys, we're coming off some very, very low volatility markets. In fact, we've only seen the Dow have a quieter, smaller, realized volatility range 5 times in the last century. If you look at this is the APTR. All of you probably know average true range. If you normalize it and go to percent, you can compare a 30,000 Dow to a 500 Dow. So there's been 5 times sub 5% on a 20, this is a monthly chart, 20-month average. 1914, very quiet, 4.7%. 1954, 4.59%. 1965, the Beatles are in America, 4.65%. January 2007, before the credit crisis, 4.77%. And just recently, we hit an all-time low, realized vol in the Dow, December 2017 at 4.5%, right? So that was the quietest range in 2017 that we've seen in a century. So what does that all mean? It's going to get bumpy. And I'm not up here saying we're going to go into a big bear market, we're going to sell off. We're going to see greater realized volatility in the years to come, whether we go higher or we go lower. So if you guys are new, kind of coming into trading, or you're looking to kind of hone your own investment profile, what you've seen over the last 7-8 years is going to be very different than what you see in the next 7-8 years. So the volatility study that we're just looking at, there's that 4.5%. Where's my thing? Oops. So that's the low in December 2017, 4.5% over there. You can see that the range typically will bring us back up to 8, 9, even 10% realized volatility on a 20-month rolling average. So we're not even halfway there in terms of what's normal for volatility. So what that means is if the Dow moves 5% higher or lower over the last 20 months, we should double that. The ranges you're seeing now should double to go up to 10%. So everyone has just tried to convince you and me that a recession was imminent, right? How many times did you hear CNBC and all the financial channels just tell you that a recession was coming right around the corner? And as a simple trend-following kind of technical trader and investor, I just kind of said, you know, if you see a train coming down the tracks, usually you just step off the tracks. If you're so sure a train's coming, just get out of the way, right? And as we just broke to new highs, it kind of seems like this whole recession scare is coming off. I almost just fell over Neto's couch where I thought he was going to proclaim his love for Katie Holmes. I didn't know where he was going with that one. Neto, are you still here? No. So along those lines, this Barron's Big Money poll I thought was really interesting. 27% of polled money managers out of this Barron's poll said they're bullish over the next 12 months. The latest reading is the lowest percent of bulls in 20 years. 27% of money managers out of Barron's are saying they're bullish on the market. Even worse, the bear rating swelled to levels not seen since the mid-90s. All right? So we have a very bearish sentiment out there with a market that just a couple weeks ago was a couple percent from all-time highs. Now we're at all-time highs. Anybody kind of find it a little funny that everyone's trying to convince you that a recession was imminent and to get out of stocks? I just said I've never seen so many, PhD-level economists calling the end of a 9-year economic expansion. I think it might be just a little bit of this. You guys ever find this when your charts are bumping up against as a keynote? I thought last year was definitely going to be my last year. I don't know, my stupid jokes. And it was myself, it was Ralph Acampora, Tom Sosnoff, and myself. I hope none of them are in the room because I have to say, if you guys remember 12 months ago, it was a very bearish environment, right? We had yet to hit the December lows. Everyone out there most people were very bearish in the market. And I'm happy to say I was the only one who stood here and said, yes, this is volatile right now, but the underlying economics and fundamentals are strong. I stayed long through that, and I told you guys last year that, in fact, I was going to do that. I didn't cut back on my portfolio at all. This is the actual chart that I showed last year. S&P looking at potential support around this 2,600, this little cluster right there, 2,500. I didn't think we were going to get the move down. Here's the updated chart to 2,200. That was a little excessive, but we ultimately held support, and here we are moving to new highs, right? So you can say the market's up 25%, but when you take out this massive October, November, December drop and coming back, we're only up about 10, 11%. So it's misleading to say, yeah, we're up 25% in the year. We just went through a long period of sideways consolidation where everyone was convinced, through various fundamental reasons we'll talk about, that the market was going to sell off. And it didn't happen. So from a technical point of view, you got to know what they're saying, but you got to know what the story is. You got to know what the fundamentals are. When you listen to TV, you want to know what people are talking about. But don't go out and change your portfolios or change your trades based on what they're telling you to do on TV. It's a three-step process. Number one, I like to look at the macro kind of picture as Netta was talking about. I want to look at the fundamentals. I want to know what they're saying. I don't want to go out and trade based on the fundamentals. I want to know what the story is. I want to know what the predominant theme is. Then what you do is you filter it through whatever technical setup that you like, whatever methodology that you like. I don't care what way you look at charts, but you have to take the theme, take the story that's permeating the markets, grind it up through your sausage maker, through your technicals, and figure out, is what actually people are saying should be happening at the right edge of the chart, the hard red edge of the chart, which is technicals. Finally, you got to deploy capital in an asymmetric risk-reward situation. Once you know what they're talking about, once you figure out what's actually happening, whether they agree or disagree, you then go put capital to work. It's a three-step process every time. And in the next 14 minutes, I'm going to give you that 3-step process. Okay. Oh, I didn't fix that. All right, so number one, let's just get this out of the way. You guys know, this is just an economics 101. You guys know if bond prices go up, the yields go down, right? We're all good with that? A lot of what's happening here, a lot of the kind of macro drivers are what's happening in interest rates, right? So the U.S. for a period of time, we were the only game in town for a good couple of years, and our interest rates, our 10-year yields were moving up much faster than the rest of the world. We tried to go it alone. We just had kind of another version of sort of taper tantrum. Remember that from 5 years ago. Markets freaked out. They said, nope, we can't have higher interest rates relative to the rest of the world because of the rest of the world, these rates are just hanging right on the lows. So we just cut rates 3 times, and we're catching down to the rest of the world. We've normalized where rates should be according to the Fed's models, and all's well now. All right, so next time you're at a cocktail party or at the tables and you want to impress, if you tell someone that you're at the investment conference, ask them what they think the relationship, now I'm looking at bonds here, between bonds and the S&P. Bonds and the S&P. Bonds trade inverse to interest rates, what I just showed you. Do bonds trade together with the S&P or do they trade opposite to the S&P? What do you guys think? Huh? Together over the long term. Because you looked at my chart? You know that. Good man. There's only 2 occasions over the last 38 years where stocks and bonds have shown a clear negative correlation. That's in 2000 and 2007. 2 significant bear markets, right? So right now we have gone negative. Go back. We have gone negative right here. And what's happened is because, right, we have seen the stock market go up. Well, bonds started to go down. Bonds down, yields up. We're starting to scare the equity traders, the equity investors. They said, nope, we can't allow that to happen. We had yield curve inversion, and they just righted that ship very quickly. All this chart says is, despite everything they're talking about the top of a 4-decade bond run, maybe just step back and say, maybe I'm not smart enough to call the top of a 40-year bull market in bonds. I fully suspect this correlation to go back positive. Interest rates drop, stocks go up. We tried to raise rates relative to the rest of the world. The rest of the world's a long ways away from raising rates. Our rates are going to be low for a long time. That's why I continue to be a stock market bull like I was last year. Okay, how are we doing? 12 minutes, all right. Thank you, Aaron. So here's the deal with the yield curve, right? This has been, this is why I want to start you real simple on interest rates, because this is really what's driving equities. And more, not only equities, but sort of the sector rotation. There's a lot of rotation happening right now. You got to be on top of it, whether you're a swing trader or investment time frame or even a short-term trader. You got to know what sectors are in favor and what sectors are falling out of favor. And a lot of it has to do with what's going on in interest rates and specifically this yield curve. I know it's been thrown at you a lot over the last couple months. And basically what's happening is you have the short end of the yield curve, which is controlled by the Fed as they move federal funds rate. And you have the long end of the curve, which is determined by your 10 and 30-year treasuries. Only about 1/3 of that is controlled by the Fed. The rest is controlled by the open market. It's a freely traded market. So it's the level of the short-term rates versus the long-term rates. A normal sloping, healthy yield curve is in this direction, right? Banks want to borrow in the short term, lend in the long run. That's the shape of a normal yield curve. What happened is it started to do this. It was more expensive in the short term than it was in the long term. That's bad, right? So that's, So that happened back in 1989, happened in 2000, 2007, and we just had it. 2000 and 2007 were the tops of 2 significant market events, tech crisis and the housing crisis. 1989, we just came out of 87. We had the beginning of the Gulf War. We did see short-term inversion of the yield curve, but nothing happened. It was the birth of a major bull market. Maybe it's like 1988 and 89 again. And if that's the case, we could be on the precipice of a significant bull market. I don't care. I'd rather trade the downside. I don't care. I'd rather trade volatility. But everyone is so sure. 27% of money managers out there a couple weeks ago were bearish on the market. I just don't see it. This is just another look at it. 10s minus 2s. We were just looking at 10s minus 3-month Treasury. We just saw a little bit of yield curve inversion on 10s, 2s, not as significant as we've seen in the past. So what's happening in terms of stocks, right? So if the yields are going up, remember, bonds down, yields up. What sectors are going to rotate into favor with higher interest rates? Financials. Look at the correlation. This chart is literally about I don't know, maybe an hour and a half old, right from the plane, right on this presentation. This is today's chart. Look at the correlation between the 10-year yield and the XLF. If you're trading financials and you want to keep J.P. Morgan going or Bank of America going or Morgan Stanley going, what macro indicator do you want to see following your stock trade up? Yields. And which way do you want to see the 10-year note trading? Down. Yields up, notes down, yields up, financials up. Whatever technical sausage grinder you have, you put it through there, you confirm with a macro indicator like rates. As we're rotating into financials, rotating into industrials, into materials, we're coming out of the dividend players, the defensive, the safe guys, utilities, and what I put in there, staples, utilities and staples, right? You can see that there's a better inverse correlation between yields and staples. So if you're long staples, you're trying to get the dividend, you're making 3.5% a year, but the stock's dropping 10 because yields are starting to move up, maybe that's not such a good trade, and we'll want to kind of move out of there. All right, so that's just real quick what I think's going on the fundamental, what people are talking about on TV. Now let's go to step 2, which is technicals. Okay, just pull out your classic Edwards and McGee, your technical analysis book. You've seen all these patterns. I take it one step further. I really, really am in love. I've been doing this forever. It's not for everybody. Gives some people the willies. But Elliott Wave is the way that I get context as to where we are in the technical position of the market. I'm just going to talk about it very briefly. I've been doing it forever. I love it. It's not for everybody. But if you sort of go down this path, study it, you get bit by the bug, and you'll never be the same trader again. So there's 2 kinds of markets that you're going to be trading in, right? It's either a directional market or a correctional market, right? You're either caught in jail, you're not going anywhere, or you're breaking out of jail and you're on the move pretty quickly. So the main way a market will move in a directional market, according to Elliott, real simple. Impulse wave or a diagonal, okay? You don't need to know anything more than that for what's going on in the current market. The main difference between impulse and diagonal is the corrections, the intervening corrections will or will not touch. Generally, you want to see a market moving higher, higher lows, higher highs, higher lows, higher highs. That's going to indicate that you're in a trend. So where are we right now in the S&P? Okay, how many people are kind of dabbling with Elliott? Know it, love it, dangerous? How many people think it's voodoo? It's evil? 61.8% of you said no, and 38.2% of you said... You can't laugh at that joke anymore. You've been here for... It's not funny anymore. So from an S&P Elliott Wave point of view, here's where I think we are, and here's the way I'm trading it. I think we just completed... Oh, don't do that. I think we just completed Wave 4, and I do think we are still very much mid-range within the uptrend channel from 09. We're not going to hit channel and fib resistance until about 4,200 in the S&P. I was on Fast Money 4 weeks ago, and I showed Melissa Lee this channel, and she almost fell out of the chair. She said, Todd, I said 3,700. I didn't want to say 4 because she would have like, whoa, stop. She loves to call me out. And I said, yeah, I mean, this is not where resistance comes in at 4,200. I said 35, 38 because I didn't want her to skewer me. But in fact, it doesn't come in until about 41, 4,200. So could we be on the start of a major bull market? Yeah, I think we could. And that's the way I'm positioned. All right. I'm going to skip a little bit. Elliot, I just got the 5 minutes on. You don't want to mess with Tracy. This misery that we've been in right here, this is the risk to my thesis, all right? Handicapping Elliott Wave for you. This mess of a price pattern here looks a little bit more corrective than impulsive. Impulsive means trending. Corrective means interrupting the trend. I am concerned about this. I definitely could be wrong. This is not really the stuff that good trends are made of. I'm happy we've made new highs. I continue to be long. I've got long, like 95% of my portfolio is long in the stock side. I'm very leveraged up. I've got NDX options on the upside. I'll show you my actual positions. But I am cognizant. I don't like that price structure that we've seen in 2019. That's the risk to my forecast right there. That's where I'll be wrong. Let's kind of go quickly through this. This is a lot of fun. And by the way, I will get kicked off stage soon, but I have a presentation tomorrow morning at 8 a.m. I'll be going into a lot of this rotation, this sector rotation that we're looking at here. Basically, what this is showing is we're rotating into value and out of growth. And I think if we are going to continue this bull market up, this is the weekly in terms of value outperforming growth. This is growth and value on the daily, okay? So growth is G, value is V. I'd like to see the growth make a move up with this software into the green quadrant would start to mean growth is coming back. Growth is technology and higher beta sectors. Okay, so this is something that I'm going to use to indicate that we're rotating back into tech and communications and discretionary. We're not there yet, but if we get it, that's going to give me more conviction on the upside. I'm going to skip that one, just showing you a little bit more growth versus value. There's support in the growth versus value ratio. We're not there yet, again, where you would favor growth over value. I think there will be a time whether you're going to be able to trade growth over value. Let me go fast. So this is the chart that, again, I used exactly 1 year ago. Internals. Okay, this is the New York Stock Exchange advancers minus decliners. This is the volume line. Okay, up here is the actual advanced decline and the volume in the advancers minus decliners. So advancing shares on the NYSE, volume summed up from volume on the decliners. Looking at some support, this was S&P exactly 1 year ago. Here's the updated chart today. We've rallied very well. We've seen nice volume come back in the advancers. We saw the S&P hold those lows. That was easy to predict. Just the simple uptrend line with divergence being that advanced decline is nowhere near support. Right? So using internals, we can easily forecast that the market was going to move higher, and that's exactly what it did. Same thing. This is advancing minus declining, just the issues. The above is advanced decline line. Below is the S&P. You can clearly see the advanced decline has been leading where the S&P has not broken out. This chart was 1 year old. Here's the updated. We just made new highs. Advanced decline has been very strong for the last year. It was foretelling an S&P breakout. That's what we got. We've just now seen mega cap financials and tech begin to move up, which is what has allowed the indexes to move higher. We've had a lot of second-tier stocks rallying, giving us the healthy breath, but only now we're starting to get large cap confirming what's happening on the upside. And I'm telling you, I remember last year like it was a week ago. The bearishness and the fear in this room was palpable. It was unbelievable, and we are so different now. And a lot of it had to do with what I'm talking about right here, which is breadth. Skip this, a little too involved for my time. I always do this. I always bite off more than I can chew. I just have so much to share with you guys, so much to tell you. I have a hard time putting 15 slides up and just kind of talk through and tell stories. All right, so executing our plan. So we looked at the fundamentals. We looked at the technicals. Is Tom Lee even in the house yet? Hi, Tom. You got anything going on after? Drink later? All right. We'll go real quick. So right now I have about 80% of my portfolio in long equities right now. 20% of it is allocated towards options. My biggest option leverage position right now is an NDX called Butterfly that I was actually working through with Mike Coe from Options Action. This is my actual stock portfolio. I just screenshotted it on the plane. I just put more money in my portfolio and my stock portfolio. I think there's a lot of opportunity ahead. I took money from another investment, put it in my stock account. So, I do trade with real money. I'll have to save this one for tomorrow. How many of you guys are trading options? Holy bananas. All right, butterflies. We're going to cover this tomorrow, 8 a.m. I'm going to show you how I use everything that I just showed you set up the butterflies, but this is the actual NDX call butterfly that I have on. 8150, 8250, 8325, broken wing call butterfly, put on about 4 weeks ago. 2,200 of risk, 17 grand max profit. We're getting close to a pin. It's going to be a very, very trying November expiration, so we'll see what's going to happen. I'll take you through the exact internals of that trade and what was behind this trade, and I'll show you the live position. Markets will be open tomorrow. Okay, guys, so that's that. Keep an open mind. The future's not written. Okay, I don't think you have to expend too much energy worrying about what the future holds. Your job, using the 3-step process that I put in front of you, or whatever process, is to execute the process perfectly, control the now, make sure you don't leave anything out, make sure you follow your process, commit it to paper, don't worry about what the future holds because you can't control it. All you can do is control the now, right? And things, as I said, volatility is going to revert. It's going to double from where we are now, even if the market moves higher. All right, so if you want this, trading analysis, tradinganalysis.com/slides if you want that. And again, I'll be in tomorrow morning, 8 o'clock. Thanks, guys.